So because this is Fortune magazine and the readers of this are investors, I know that you have some things to say about how you've positioned your resources portfolio, but I also want to hear from the technology side. We keep saying tech is this idiosyncratic engine of growth. If that's the kind of thing that investors have to look for in 2016, are there enough opportunities that haven't been fully exploited? So Facebook is now a $300 billion market cap. Google is well on its way. You know, are there other things that investors can do to find that secular growth? And are there things that we can do to take advantage of moribund commodity prices to make money in industrials or whatever the case may be? I'd love to just go around and get an answer from everyone. If you'd like to start, Kate.
Sure. Well, I think lower commodity prices are benefiting not just tech, which isn't very commodity intensive,
right,
but consumer staples, consumer discretionary. And it's lots of other companies use those inputs. And while we talked about how revenue growth is slow and companies are making earnings for cost cutting, part of that cost cutting is lower energy prices, is lower commodity prices. So I think where you look for growth is in companies that have continued to see some revenue growth, but are able also to be able to grow earnings because they're benefiting from some of these other trends.
So could you share some examples?
Sure. I'd look at companies in the consumer staple area like Pepsi, where basically you're still getting that growth, but not, but it's not because there's lots of demand growth. It's because there's lower commodity prices coming in.
Okay.
So I'd be looking at companies like that where you still, it's everybody's looking for growth in this very, very low growth environment, and that's a place.
And Devin, if we're going to chase this idea into technology companies, I promised you we weren't going to have the bubble conversation today because it's pretty tired. Where are the opportunities for the investor looking at 2016 and saying, I want growth, but I don't want to feel foolish if the cycle does turn?
Well, look, we don't take a one-year horizon because we're not a hedge fund, but I can talk more generally about trends. But you said something earlier, which I just want to give some facts on, which is you said that in effect in tech, the rich are getting richer. And that's true in certain subsegments. Internet advertising would be a great example of that.
Right.
But if you take an example, if you look at software, if you look over the last 10 years and you break the market up into three categories, the top 10 companies from revenue, then 11 through 100, and then the rest of the industry. We would kind of focus on the rest of the industry because the rest of those companies are public.
Right.
1 to 10 over the last 10 years have lost market share. 10 to 100 have basically been constant from a market share standpoint, and the rest have picked up about 6 points of market share. So there's still tremendous, and the entire pie has gone up about 3x in terms of actual dollars. So it's very few industries where you can have that much growth in emerging companies and have the total pie grow and have every subsector still have grown, right? And that's what's happened in
So
tech.
what areas within software should investors be looking at? Is it cloud? Is it CRM?
Yeah, so we focus on really two broad areas. We focus on enterprise software, and then we focus on consumer internet. And we think there's still tremendous opportunities in both sectors. So I think that we talked about this a little bit earlier about how everybody wants to talk about software as, whether it's eating the world or it's disruptive. But when you think about it, really, I view this as much more enabling the world. And there's not a business process from whether you go to the ATM in the morning, you get into a cab, no matter what process you do, there's a software is touching a bigger and bigger percentage of that interaction.
And that's going to grow regardless of cyclical.
Right, because if you talk to most Fortune 500 companies, and we spend a lot of time, even though we don't invest directly in Fortune 500 companies, we spend a lot of time talking to them about what are they doing. All of them say their highest ROI from a CapEx standpoint is in software. And so they're all generally increasing IT budgets, and IT budgets have been on a 15-year growth path. I think they'll be on another 15-year growth path. Now, are you going to have industries, oil and gas, that are probably going to invest less in IT for the next few? Sure, you're always going to have that. But if you look at it on a consolidated basis, that's not the case. The reason why I'm not as bought into everything having to be disruptive is take an example that's been very popular in the venture world, which we haven't invested in, which is fintech. There's this whole world of lending clubs, and companies are going to disintermediate Citibank.
Not a good year for the
It hasn't been a good year, and I think there's a couple of reasons, because I think the one thing that people underestimate is that brands still have value. If you go we're not investors in Lending Club, but if you were to call them up and ask them what are one of their fastest growth channels, they'll tell you direct mail, okay, which is not really sexy. And if you think about it, if you think about their unaided awareness, my guess is it's not very high. If you think about Citibank's unaided awareness, it's extremely high. So what are banks doing? They're coming up with better technology solutions to provide similar services to their consumers. And that's true across lots of industries.